Hello Sector Watchers, welcome to the show. This is the 94th episode of Sector Spotlight for Tuesday the 31st of August, recording it on Monday the 30th. My name is Julius the Kempenaer and I am presenting to you from Amsterdam in the Netherlands. If you want to stay in touch, please use any of the handles on the screen. We love to hear your feedback and we will actually respond to it. Today is the last Tuesday of the month. Normally that would mean that we're going to look at seasonality. Because this Tuesday is the last Tuesday of the month, and otherwise we would need to wait for a whole week before we could talk about completed monthly charts. Those of you who've watched last week's episode know that I've pushed the seasonal bit forward 1 week. So we talked about that last week. And today we're going to talk about the completed monthly charts. So if you're tuning in to watch this seasonality, you got to go back to YouTube or the OTT channels to actually watch last week's episode, because that's when we're talking about seasonality. So today the majority of the show will be dealing with the completed monthly charts, and obviously we'll have a quick look back at what's going on right now on the relative rotation graphs. However, before we start talking about markets, I would like to grab your attention, use this opportunity to promote a foundation in the Netherlands that I think deserves our support. And maybe not for you guys in the US, that's the majority who's watching the show, or if you feel like you want to support a Dutch foundation, then hey, by all means, go ahead. But maybe if there are a few Dutch people and you got any affiliation with the military and especially with the special forces, stay tuned. The foundation I'm talking about is the Commando and Family Foundation. It's run by a couple of people who are ex-special forces operators, and they started a civilian outlet doing training for police, special services, special forces, every first responder. Pretty impressive outlet, I have to say. But more importantly, this Commando and Family Foundation is actually supporting active and retired ex-special forces who need help. And unfortunately, there are too many of them. Too many of these men and women have a ton of problems that we cannot even imagine. And I don't even want to go there, but there's a lot of people who need help and they can't get it from the normal channels, or a lot of them can't get it from the normal channels. And that's where this foundation is jumping in by helping them, not only with money, but with efforts and care and a listening ear. That's a lot of times that's a lot of help to these people. The shirt that I'm wearing is actually the reason why I'm wearing it. It's got the, it's a line of clothing that is sold by the Commando and Family Foundation, and it's called Danger Clothes. And there's a little bit of a story there that I think makes sense, a little bit of a backstory. Oh, and by the way, if you don't like all this chatter about military and supporting people, go to the time frame, to the next frame of this video, and that's where we start talking about markets. So Danger Clothes is actually referring to a situation where it's military jargon. Danger Clothes is where operators on the ground are very close to enemy forces, and they need help, they need support, and very often that's where my friends from the Air Force came in to provide air support. So that's the Danger Clothes versus Danger Close. That's a nice play of words, actually, a nice metaphor. The badge actually has a grid coordinate, and if you look that up on your map, you will find that is the base camp for the training center of the Green Berets in the Netherlands. Every Green Beret was trained there, and actually every officer cadet, including myself, had to go through what we called a combat course. It was nothing compared to the elementary commando training, and it's probably the worst 2 or 3 weeks of my life. Looking back, it was all very good, but at the time when you're in there, you really don't like it. And the other element is the Fairburn Sykes Commando Dagger that's in the badge actually, and it stands for courage and daring. Anyway, go to their site commandoandfamilysupport.nl. If you don't speak Dutch, right click and Google Translate will do a very great job in translating it to English. If you want to go out and buy a nice t-shirt or a nice sweater like this one, please go ahead, and you know that you will support a very good cause. Enough of that, we're going to talk about markets right now. We kick off with the rotation for asset classes. Then on the daily RRG, we see that especially both commodity ETFs did very well last week, 7 and 7.5%, and you can clearly see the long tails picking up on the RS momentum scale. So they seem to be getting back on track. If you look at the VBINX, the benchmark actually gained 1.2%, and stocks led again, once again, a very good week for the stock market, up 2.1%. And that means that fixed income stuff was at least below the 1.2%. So we got high yield at 0.8%. We got corporate bonds at 0.1%, and we got government bonds losing 20 basis points. Real estate is picking up slightly. It's inside the lagging quadrant, but picking up. Not there yet, still losing on the relative strengths RS ratio scale, but seems to have lost its downward momentum. So that's the good news. Now, if we translate that to the right-hand side where we have the weekly RRG, then we see that the long tails for commodities are still there. DJP has started to pick up. GSG is still, it's leveling off, but it's still heading lower. But I think it fits the belief and the narrative that commodities are in a long-term turnaround situation. And if we get the continuation of the pickup here that we see on the daily RRG, that could very well lead to a further rotation back up for both DJP and GSG. V&Q measured on the RS ratio scale, still the highest reading, so for that matter still the strongest asset class. And if we look at the performances over the last 5 weeks, then you can see that ITOT is up 2.4%, VBNX 1.4%, and then V&Q is up 1.1%. Not fantastic, but still higher, and we're not losing any money there. If we look at the fixed income, then we see that that is concentrated inside improving, and high yield has just dropped into the lagging quadrant, but they're all moving lower on the momentum scale, and that means that that stocks remain the favorite asset class for the moment. It doesn't really matter what you think about stocks in terms of absolute performance here against VBINX, which is a 60-40 mix of stocks and bonds, and that's aggregate bonds, not only government bonds, but a whole bond complex. Stocks remain the preferred asset class for now. When we look at the rotations for sectors, we have the daily rotations on the left-hand side, weekly rotations on the right-hand side. And as you can see, it was a lot of momentum-driven moves last week. Most of the moves, most of the tails are moving almost vertically. So that means momentum, because the vertical axis is the JDK RS momentum scale. What you can see is that very clearly we have like healthcare, utilities, materials, financials, industrial staples all rapidly losing momentum last week. The pickup of momentum was in technology, communication services, real estate, and in discretionary, consumer discretionary, and only in the last part of the week energy picked up. You can see that those tails are relative in nature and they depict trends, and that does not necessarily immediately reflect the absolute performance of these sectors. Because as you can see, energy was the best sector last week with a gain of 2.4%. But if you look at the chart, It's actually the weakest on the RS ratio scale, and it only picked up a little bit of momentum in the last 2 days of the week. If we look at discretionary, it's the third with 1.8, is still far left. And if you look at the all these in the yellow quadrant, the weakening quadrant, then you will find here materials actually gaining, and healthcare, utilities losing 60 basis points, and staples is actually inside the lagging quadrant, also losing 60 basis points. The story of the last few weeks remains largely the same. Conflicting rotations, confusing rotations, not a very clear message from the rotation. Market itself continues to crawl higher. We'll have a look at the chart later on, but the situation didn't really change a lot. You see the same here with the weekly RRG, where it's still tech and healthcare inside the leading quadrant, although they are losing a little bit of momentum, but they continue to move higher on the RS ratio scale, so they continue to pick up relative strength and outperform the benchmark, so that's a good thing. And then we have real estate, which is the highest reading, still pretty good, but losing momentum. And the same goes for communication services, although communication services is now coming pretty close to crossing over into the lagging quadrant. So going back to my intro, that's danger close. We need some support here for the communication services sector. Inside lagging, things remain the same. Energy, very clear downtrend. Long tail, long power, a lot of power further down. A little bit less, but still moving lower on the RS ratio scale for industrials, financials, and this is materials. And then we have staples actually rotating back into the lagging quadrant. So that's there. And that's one of these confusing or conflicting things. Normally, you would expect risk on and risk off sectors to move together. And here you got utilities and staples very close together, but utilities is at a positive RRG heading. Staples is at a negative RRG heading, and that remains something to keep in the back of your mind. Normal markets have some sort of a regime that they always go through, and in a risk-off scenario, utilities and staples and healthcare are most of the time moving in tandem. Same for offensive sectors; they used to move in tandem. Like tech, real estate, but also materials and industrials, and they go down. Tech goes there. Discretionary did pretty well, but it's now starting to roll over. As you can see, it's starting to make that little rollover. So we're still getting signals and rotations that are all over the place, and basically the message is to remain cautious, at least from my point of view, from a sector rotation point of view. I'd like to remain cautious because I don't get a very clear message. If we take a quick peek at the chart of SPY, then we see that this chart, the annotations are still pretty much there. The divergence that we've been watching is still there, although I have to admit that it's getting less and less and less. It's getting more horizontal, but these little highs here in that RSI are not higher yet. So it's not the strongest of divergences anymore. It's not like here where you had a very clear lower high and a higher high in the price. Here we have some sort of a sideways divergence where the highs in the RSI are now pretty much at the same level, while the highs in the price chart are crawling higher. It still remains a dangerous situation in my view, but we've got to be prepared to change the attitude, to change the approach of the market when all of this starts to turn around in coming weeks. So it's a situation that needs proper monitoring. Problem is that if you put something like the MACD underneath this chart, you'll see pretty much the same. You see that the MACD is not confirming, is not going to new highs either. It's actually, it's also rolling over. Let's have a quick look, and if we zoom that in, it's almost the same. There's nothing there, but it's definitely not confirming the uptrend that you had in that MACD thing. If you go to the daily, then you'll see that now actually a new divergence seems to be building up, because it was sort of negated here when we had this divergence here, and then it picked up and it went higher. And now, let me put my cursor here, you can see that this high is corresponding with the high in the RSI, and we're not above that now. So we're building up a new negative divergence in the RSI on the daily chart. So again, you know, even if you would have thought that on the weekly it would have changed the situation, now the daily is starting to diverge again. All in all, it remains in my view, a weird situation, pretty dangerous situation. We're making new highs, that's all bullish, but the underlying strength is not there. Add to that the weird rotations that we see on the RRG, the weird sector rotation where offensive, defensive rotations are not confirming each other. It makes a sort of a boiling pot that that I think needs to be monitored very closely, and I'd rather be out of the market or not enough in the market than be 100% long when the market comes crashing down. So I'd rather miss a little bit of upside than participate in a lot of downside. Let me put it like that. We're gonna wrap up here the discussion on current rotations, and after the break we're gonna look at the monthly charts for a number of asset classes and all the sectors. So this time I'm going to start with the sectors. Usually I start with asset classes, turning it around today. Let's go over them. The communication services sector. Now remind you, this is looking at absolute price performance. There's nothing to do with relative strength. We can make it a little bit of a visual relative strength, but these are price charts, and we're looking at price trends in an absolute way, just to build a picture, to get an idea about what's going on in the longer term time frames. Looking at this chart, communication services, no doubt about it that this is an uptrend, and this sector actually made a well, actually did not make a new all-time high or closing high, because these were made back in the late 90s and well, actually 2000. So this one is still crawling higher, but this trend is very, very strong. And what you will see on each chart is where I've labeled the distance in percentage points to what I think is the next support level. Obviously we're breaking a level here, but there is no, in this last move, there's no real new high or new low. So first one is about 25% lower, and then the breakout level is even 36% lower. Long-term trend, definitely higher for communication services. Looking at consumer discretionary, same story. Uptrend very much intact, pushing to new highs. This is a new closing high this month, so that is a good thing. We're actually still working our way higher after this sector broke from this already rising channel. At the start of 2020 actually that happened, so this is on the way for quite some time. First support level about 10% lower, next one 29% lower, maybe a little bit less when you take the old resistance. Uptrend definitely intact for consumer discretionary. Here is staples. Uptrend intact, not as strong as the others, which is to be expected with a more defensive sector. It's very gradual, very going. But look at this, the downside risk here, I'd say it's around 6%. So we're going to give you a roundup later on, but definitely one of the sectors with the lowest downside risk. Go to energy. This is the only sector, spoiler alert, that is in a downtrend. And you can see that it has now definitely put in a lower high once again against the old support level, which was broken at the start of 2020 and has now acted as resistance. So this sector is moving lower. It's in a downtrend. So long-term trend for energy, definitely lower, definitely down. Financials actually doing very well after the breakout, moved higher, still doing that. And here, this is a sector where we can now, because we actually have put in a new higher low, we've moved up the risk. So for the financial services sector, or the financial sector, the first support point is about 10% lower, and the next one is 20. This one was not there last month, so this is actually a good thing for the financial sector. The uptrend is intact, and has begun after it broke above that horizontal boundary in the 515 area. Healthcare, defensive sector doing very, very well. We talked about it a while ago, making healthcare as the where you can hide for defense, or moving higher for defense. Still moving higher after the break out of the rising channel. New high, new all-time high, new closing high. I'd say downside risk 11%, and if we go all the way down to here, it's about 20%. The uptrend is definitely intact. We go to industrials, then that's also one where we can now raise the first support level. This low here is now in place of last month, or this is then July and this is August. So downside risk now limited for industrials. I'd say first level around 6%, and then it's about 19%. Nevertheless, the uptrend fully intact, no problem at all. Technology, darling baby, moving higher still, new all-time high, new closing high. As a result, the downside risk is increasing. So first support level a little bit more than 20% lower, and then the more serious, you see, is a cluster of monthly lows here, which is about 30%, 31% lower. The uptrend here is definitely intact. Let there be no doubt about it. And that'll be the major story for all these sectors. These uptrends predominantly are intact, but the risk is increasing. So the long-term uptrends are intact. Does that mean that we will shoot higher week after week, month after month? I don't think so. We go to materials. Again, the uptrend is intact. However, we've put in, it looks as if we're now putting in a new higher low. So here, materials also one of the sectors where we can raise the support level. This is about 9%, 8.7, and the breakout level here is 25%. So it's a first higher low in place, which is a good thing, and it's supporting the further rise of the materials sector in the longer term. This is a monthly chart. We're talking about long-term trends here. A lot can happen, with these long-term charts. We can have 10-20% declines without hurting these long-term uptrends. Real estate, same story. After the break, continuing higher. Actually done pretty well last month, holding up very nicely. I think the first support level around 12% lower, and then there is a little bit more, I call that meat in the support, a little bit more touch points, is about 15.6% lower. If you go to utilities, that's an interesting sector. Because most of the months recently, this was not in an uptrend, as you can see. And it was not making new highs, it was not making new closing highs. And now, this sector is now breaking out, because we are now at 347, which is right here. And we're breaking above this falling resistance, which is in play for a year and a half now. And it's getting out of the doldrums, getting out of that consolidation. And it looks to be, well, I think it is going to be in an uptrend, higher highs, higher lows. This close here, if we maintain that level, like 347, 348 at the close tomorrow, it'll be higher than the close, which is here, is 339. So this is establishing a new uptrend. Problem is, it's utilities. It's a defensive sector that is going to reverse its consolidation into an uptrend. Talking about confusion, talking about conflicting signals. And when we wrap all of this up in the table that you may now get used to, we get the following. Here we have the performances of last month, and we can see that the energy sector was the only one which was down in price terms, and the strongest was for utilities. Again, utilities, strongest sector. Information technology up 4, communication services 5, financials 5, 4, etc., etc. We go to the new all-time highs, then we see that staples, financials, healthcare, technology, and real estate were the sectors that set a new all-time high. If we go to closing highs, then we see that discretionary set a new closing high, not a new all-time high, but only a new closing high. Staples set both, so two marks. Energy, obviously not. Financials also set a new closing high. Healthcare also set a new closing high. Technology also set a new closing high. And real estate also set a new closing high. So they're back in tandem. The only exception is discretionary, where we did have a new closing high, but not a new all-time high. And we have energy, utilities, materials, and communication services that are both below their closing highs and their new all-time highs. The result is that pretty much all sectors are in an uptrend except for energy. And we discussed the amount of downside that's available for every sector, which I think is very significant. It has been raised for a number of sectors where we had a new higher low in place on the monthly chart, which means that we can shift the first support level a little bit higher. If you look at the at this wrap up, at this summary here, then we have 59% of market capitalization. So what I do is I add up the weight for these sectors when they tick a box. So for the new highs, that means that we have 59% of the market making new highs. We have 72% of the market making new closing highs, and we have 97% of the market capitalization in the S&P 500 in an uptrend. That is a good story for the long term. However, the downside risk is significant, and that keeps us on our toes with regard to the various sectors. Because of time in the asset classes, I'll only look at the S&P 500. All the other charts are largely the same as we discussed them last month. Uptrend in the S&P 500, monthly scale, more than intact. But the downside risk, over 20%, maybe even lower. That's in line with the average that we saw on that table for all the sectors. So the basic message, I think, is and remains that the long-term trends are intact, but the short-term risk is definitely there, and it's increasing. And we do need to have some sort of a consolidation, I think, before this can all continue higher at the pace we have seen recently. Ladies and gentlemen, this concludes Sector Spotlight for this week. Thank you for watching again, and we appreciate your comments and your feedback. Remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern, and I'd love to see you again next week, same time, same place.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.